The Bank of England, the BOE, has just put out a warning that honestly is pretty hard to ignore. They're basically saying that the mood right now in the global economy has these uncomfortable parallels to two of the biggest financial collapses we've seen. We're talking about the dot-com crash in 2000 and, of course, the 2008 global financial crisis. So today, we're doing a deep dive into the BOE's latest financial stability report. Our mission is to figure out exactly where these big systemic risks are, why the central bank is so worried about an artificial intelligence or AI bubble, and, what they're actually doing about it.
And the language they use in this report is it's incredibly specific. The BOE warned there's a risk of a sharp correction in the value of major tech companies. To put that in perspective, they say UK share prices are close to the most stretched they've been since 2008.
Since 2008, wow.
But here's the kicker. When you look across to the US, their equity valuations are, and this is their word, reminiscent of what we saw right before the dot-com bubble burst back in 2000. So it's a really strange signal, isn't it? It's like this extreme tension between risk and resilience.
That's what's so unsettling. It's an echo of two totally different crises at the same time. One was all about, speculative tech. The other was about systemic debt. But they do single out one area, don't they? Saying valuations are particularly stretched for companies working on AI. Let's start right there. What is it about AI that makes it the kind of epicenter of this potential bubble?
I mean, the scale of this is just it's staggering. The BOE is looking at these industry forecasts that say spending on AI infrastructure could top $5 trillion.
$5 trillion.
Yeah, that's 3.8 trillion pounds just in the next 5 years. I mean, that's a speed and a volume of investment that we just haven't seen before.
And what's really fascinating here, and this is the financial stability part, isn't just the amount of money, but how it's being financed. The BOE figures that about half of that $5 trillion has to come from outside sources. And they make a big point of this. Most of that external money is being raised through debt.
So it's leverage. It's all about leverage. And that's where the systemic risk comes in. I mean, the report says, and I'm quoting here, deeper links between AI firms and credit markets mean that should an asset price correction occur, losses on lending could increase financial stability risks. So think of it this way. If the stock prices of these AI companies suddenly tank, the bubble pops, then lenders who financed everything are left holding collateral that's suddenly worthless. And that instability can spread, way beyond just the tech industry.
And it's not just the BOE ringing this alarm bell.
No, they're not alone at all.
They mention the IMF, the International Monetary Fund, and the OECD as well. And even some huge figures in banking are speaking up. Jamie Dimon, CEO of JP Morgan, he told the BBC he was far more worried than others about a big market correction coming. I think it feels like a consensus is building around this idea of stretched valuations.
It does. And just for context for everyone, when we say the dot-com era, we're talking about the late 90s, this huge rush of internet companies whose value was just pure optimism. Many had no real revenue.
Yeah.
When that bubble burst in 2000, it was a mess. Mass bankruptcies, huge job losses.
And that kind of thing has a very real personal impact, doesn't it? A drop in share prices hits the value of your savings, your pension funds. We're talking about families who saw their retirement plans just, evaporate overnight.
Absolutely. And you can see why the BOE is nervous when they see this kind of capital expansion happening so fast.
But what's the key difference then between the year 2000 and today?
Oh, that's the crucial nuance, and it comes straight from the BOE governor, Andrew Bailey. He was very quick to point out that today's AI companies are not like the dot-com ones. He said they mostly have positive cash flows. In his words, they not created on hope. And that's a huge difference. They're actually selling products, selling services, not just promises.
Okay, so they're real businesses, but there are still risks.
Oh, for sure. Bailey pointed out two big ones that are still there. First is concentration. He said the U.S. AI sector is very concentrated, which means just a handful of giant companies make up a huge chunk of the whole U.S. stock market. If one or two of those giants stumble, the entire market feels it.
So the whole market is sort of balanced on the success of just a few massive players. That sounds pretty unstable.
Precisely. And the second risk is just intense competition. You mentioned the whole debate about whether Google is, quote, moving on to NVIDIA's patch.
Yeah.
It just shows how fast things can change in this sector. Today's market leader could be gone tomorrow if they don't keep up.
So does this mean the BOE thinks AI is all hype? That it isn't going to be this big revolution everyone's expecting?
No, not at all. And Bailey's final point on this is really important. He separates the financial risk from the tech progress. He said it's totally possible that AI turns out to be the next general-purpose technology.
Yeah.
Something that creates huge productivity growth. Even if we go through a really painful market correction first, the long-term revolution doesn't make us immune to short-term debt-fueled bubbles.
Well, right. So that's the market risk. But what about the banks themselves? Let's switch gears and look at what the central bank is doing to protect our high street banks, because they've just announced a pretty major policy change. They're proposing to lower the amount of capital banks need to hold. And that's the first time they've suggested a reduction like that since the 2008 crisis.
It's a huge move, and we should probably explain what that means. The BOE proposed lowering the benchmark for what's called Tier 1 capital from 14% down to 13%. Now, Tier 1 capital it's the really high-quality stuff. Shareholder equity, retained earnings. It's the core safety buffer meant to absorb any unexpected losses.
Okay, so if that capital is their main safety buffer, why on earth would you lower it? Especially right after you've just warned everyone about stretched markets. I mean, that sounds completely contradictory.
It does seem that way, and that's the central tension in this whole report. But the goal of the bank's Financial Policy Committee is to get lending going. By lowering that requirement, they basically free up billions of pounds that banks can then use to offer new loans to households, to businesses,
Okay.
all to try and boost economic growth.
Okay, but is it safe?
Well, the BOE argues that it is,
Hmm.
and their confidence comes from these really tough stress tests they just ran. They put the high street banks through this nightmare scenario, unemployment doubling, house prices crashing by 35%, the economy shrinking by 5%, and the banks sailed through it.
So the argument is that the banks are so much more resilient now, they can afford to release some of that capital without risking the whole system.
Exactly. And even with this cut, the BOE says the banks will still hold a massive safety buffer, something like 60 billion pounds above the new minimum requirement. That 60 billion is there to absorb losses long before the taxpayer's ever at risk. And these changes aren't even coming in until 2027, so there's plenty of time to prepare.
All right, that makes sense for the big institutions, but let's bring this down to the personal level. For you listening at home, specifically for homeowners. Inflation is coming down, but how are those interest rate hikes from the last couple of years still playing out? Because those ripple effects are definitely still moving through the system. The BOE is projecting that 3.9 million people, that's 43% of all mortgage holders, are going to have to refinance their loans at higher rates between now and 2028. This isn't over. It's still happening.
And the report lays out the specifics, and they are pretty painful. The typical homeowner coming off a fixed rate in the next 2 years is looking at an 8% jump in their monthly bills. That works out to about an extra 64 timers a month. And for families already struggling with the cost of living, that's a serious hit.
A significant amount.
It is. But, and this is a really important bit of context, it's not a universal story. Not everyone is facing a hike. Interest rates have actually come down quite a bit since their peak back in 2022. The BOE base rate, for example, has dropped from 5.25% down to its current 4%.
So that fall in the base rate is already making a difference for some people.
A huge difference. As a result, the BOE thinks that about a third of mortgage holders will actually see their monthly payments fall in that same period. This is mostly people on variable rates, or maybe people who locked in a fix at the absolute peak. So it's a messy adjustment, with winners and losers, and it all just depends on when your mortgage deal ends.
That adds a really important layer of complexity to the story. Okay, so we've covered the AI bubble risk, the policy shift on bank capital, and the ongoing mortgage pain. Before we wrap up, what about the other big risks on the horizon, the things coming from outside the UK?
The report gives a quick summary of these global issues that are still a threat to UK stability. They list rising geopolitical tensions, which we see everywhere, the growing threat of global trade wars as countries get more protectionist, and, maybe the most important one, rising borrowing costs for governments all around the world.
And how does that last one, governments paying more for their debt, how does that affect us here?
Well, it becomes a domestic problem very quickly. When governments everywhere have to spend more just to service their own debt, it means there's less money flowing into international investment. That makes it harder for UK companies to raise money and grow. It just tightens the global money supply.
And I noticed they mentioned security as well, a specific threat linked to all this international tension.
They did. The BFO explicitly said that the growing tension between major powers has significantly raised the risk of sophisticated cyber attacks. And they're not just worried about data theft, they're worried about attacks that could hit the core financial infrastructure. Payment systems, trading platforms, things that could bring the system to a halt very, very quickly.
Okay, so let's try and pull all these threads together. We have the situation where fundamentally the economy looks pretty resilient. The banks pass their stress tests. They've got this $60 billion buffer. But at the very same time, the risk signals are flashing red. Market valuations in AI are stretched. Millions of homeowners are still facing higher bills. It's just a complete mix of signals. It must be creating some real cognitive dissonance for people trying to save and invest.
It really is. And to bring this directly back to your personal finance choices, you have to look at what the government is doing. The chancellor, in the recent budget, was actively encouraging savers to move cash into stocks and shares. They did this partly by cutting how much you can save in tax-free cash ISAs. It's a policy literally designed to push your money out of safe cash and into the stock market to try and fuel growth.
Which creates a direct conflict, doesn't it?
A huge one. The government's saying put your money in the market, while at the same time the central bank is saying be careful, the market is near historic highs and looks a bit like the dot-com bubble.
Which brings us right back to where we started. So, considering the BMO is explicitly warning you that equity valuations are stretched, what does the government's push to get your savings into stocks actually mean for you? It really raises a critical question for your own planning. Are you willing to trade that safety for potential growth right now, knowing the central bank is telling you the market is walking on a historical tightrope? That's something for you to really think about as you assess your own appetite for risk in this very uncertain moment.